Imagine for a second that you're a Wall Street algorithmic trading bot. You just scrape the internet 24/7, hunting for, the slightest mathematical edge.
Right, just endlessly looking for data.
Exactly. But today, when you try to pull the Q1 2026 earnings data for this seemingly quiet regional bank down in the Southeast, you hit a massive digital brick wall.
Oh yeah, the Cloudflare block.
Right. Instead of a balance sheet, you just get this block. It says, performing security verification. This website uses a security service to protect against malicious bots. It demands JavaScript, cookies, the whole 9 yards. We even have the specific Ray IDs from the network blocks in our source stack today.
Which is incredibly detailed.
Yeah, literally right here, 9FD1 Babe 6157 and 9FD1 Bear 8562197. It is honestly like encountering a highly aggressive bouncer at, well, a really boring accounting party.
That's a great way to put it. And I mean, those two automated security pages from marketbeat.com, they actually tell a crucial story before we even look at the bank's actual numbers.
Why is that? Why is this specific financial data guarded so heavily against automated bots?
Well, in our current era of algorithmic trading, raw financial truth is intensely guarded because it's just so intensely valuable.
Right, because of the speed.
Exactly. Algorithms are programmed to digest newly released earnings reports and then trade on keyword changes or, metric shifts milliseconds before human traders even finish reading the headline.
Oh, wow. So they just overload the system?
Yeah. The data platforms have to build these massive digital walls just to keep their servers from melting down under the sheer volume of automated requests.
Okay, let's unpack this. Because once you actually get past those digital bouncers and look at the raw Q1 2026 earnings report from ServisFirst Bank Shares, Inc., trading under the ticker SFBS, by the way, you immediately see why the data is guarded so heavily.
It's a gold mine of information.
It really is. Today, our mission on this deep dive is to decode the true health of regional banking in the spring of 2026 for you, the listener. And this raw data reveals a rather explosive start to the year.
What's fascinating here is the sheer volume of wealth generation happening totally under the radar.
Yeah, it's not making front page news.
Not at all. But when we look at their top-line numbers, net income for the quarter hit $82.9 million.
Wait, 82.9 million?
Yeah, that is a 31% increase from the first quarter of 2025.
That's massive.
It is. We are talking about a regional bank expanding its bottom line by nearly a third in just a 12-month period.
And their diluted earnings per share, meaning, the metric that factors in all the potential shares that could be claimed by executives or stock options that hit $1.52.
Right.
But as I was reading through the source material, I noticed a very specific quirk in that EPS number.
BOL adjustment.
Yes. It includes a $1.0 million accounting reversal related to BOI, or bank-owned life insurance, income from the fourth quarter of 2025. So that reversal cost them about 2 cents per share. If you exclude that BOI adjustment, their EPS would have been $1.54, making it a 33% increase.
Which is even stronger.
It is, but let me push back here as a skeptical observer.
Okay, go for it.
If a bank reports a massive 31% jump in net income, but their report includes $1 million accounting reversals for life insurance, are we looking at actual core banking success, or are they just shuffling numbers around to make the quarter look artificially good?
It's a fair question. Seeing accounting reversal on a balance sheet should always trigger your skepticism.
Definitely.
But the mechanics of bank-owned life insurance actually point to a highly disciplined strategy. It's not a trick.
How so?
So BOI is a standard tax-advantaged practice where a bank purchases life insurance policies on its key executives, with the bank itself as the beneficiary.
Okay.
They do this specifically to offset the massive ongoing costs of employee benefit programs. In the previous quarter, Q4 2025, ServisFirst received a death benefit that temporarily spiked their income.
Ah, got it.
Yeah. So in Q1 2026, standard administrative true-ups required them to adjust that previous amount downward by $1 million.
So the adjustment actually artificially lowered their Q1 performance.
Exactly.
The raw engine of the bank is performing even better than that $1.52 per share suggests.
Without a doubt. And the real proof of that engine's performance is their efficiency ratio. For Q1 2026, it dropped to 29.80%.
Which is just wild to think about.
It really is. In the banking world, the efficiency ratio measures overhead, like how much a bank has to spend on salaries, buildings, and technology just to make $1 of revenue.
So an efficiency ratio of 29.80% means ServisFirst is spending less than 30 cents to generate a full dollar.
Right. And to put that in perspective, most regional banks are absolutely thrilled to keep that number under 50 cents.
Yeah, 50 is usually the gold standard.
Staying under 30% for the second consecutive quarter is incredibly rare. It's exactly why you see their CFO, David Sparacio, quoted in the report highlighting their margin expansion and their 1.89% return on average assets.
A 1.89% return on assets.
Yeah, a typical benchmark for a strong return on assets is around 1%. They are operating in an entirely different tier right now.
Generating almost a 2% return on assets is fantastic, but my immediate worry is how they actually got there.
Because of the risk factor.
Exactly. Usually in finance, you only get those kinds of returns by pushing your chips to the middle of the table and taking massive risks. It is super easy to make money if you're gambling with high leverage products.
Right, but the data says otherwise here.
It does. Looking at the balance sheet and our sources, they seem to be winning by playing aggressively safe. They are sitting on $1.84 billion in cash and cash equivalents.
That's a huge safety net.
It's 10% of their total assets just sitting in highly liquid form. For anyone feeling a bit of economic anxiety in 2026, seeing a bank hoard nearly $2 billion in cash is a pretty strong indicator of stability.
That liquidity buffer is very intentional. But, the most crucial detail on their balance sheet isn't just the cash they have. It's actually the type of money they refuse to touch.
The broker deposits.
Yes. The report shows they have 0 FHLB advances, meaning 0 loans from the Federal Home Loan Bank, and 0 brokered deposits.
I was thinking about this, and using brokered deposits to grow a bank's balance sheet is honestly a lot like renting friends to make your party look full.
Oh, that's a perfect analogy.
Right. You pay a high premium to a third-party Wall Street broker to just flood your vault with cash from anonymous entities.
Mm-hmm.
Those depositors don't care about the bank's long-term vision at all. They just want the absolute highest yield possible. The second the broader market offers a slightly better rate, those rented friends just vanish, and the bank is left facing a massive liquidity crisis.
If we connect this to the bigger picture, carrying 0 brokered deposits is a massive flex of institutional strength in 2026.
Because everyone else relies on them.
Exactly. In times of economic friction, fragile banks get desperate to fund their loan pipelines, so they turn to that expensive hot money. ServisFirst took the exact opposite route. They actually managed to drop the cost of their interest-bearing deposits to 2.79%.
Just to put that in context, that is a drop of 61 basis points, or a little over 0.6% from the first quarter of 2025.
Which doesn't sound like a lot to a normal person.
But for a bank holding billions of dollars, dropping the interest you pay out by over 0.5% represents a gargantuan amount of saved capital.
Absolutely. And standard economic theory suggests that if you cut the interest rate you pay your depositors, those depositors will just take their money to a competitor paying more.
Right, that's the risk you run.
Yet, ServisFirst grew their total deposits by $268 million during the quarter.
That is wild. They told their clients they were going to pay them less, and the clients actually gave them more money.
Yes. That implies their commercial and retail clients value the platform, the service, and the relationship far more than just squeezing out every last fraction of a percent of yield.
It's actual loyalty.
Because they pay so little for their raw materials.
Mm.
The deposits, their profit margins on the $249 million in new loans they issued this quarter are just incredibly thick.
But here's where it gets really interesting.
Because no balance sheet is invincible. Even with an ironclad deposit base and a mountain of cash, we have to look at where the bank is actually bleeding.
Sure.
The sources show, but you really have to contextualize a $6.7 million loss against the broader mechanics of their operation. Yes, taking a charge off means a client definitively defaulted, and the bank had to absorb that hit. The money is literally gone.
Right.
However, for the first quarter alone, their net interest income, which is the pure profit from charging higher rates on loans than they pay on deposits, was $148.1 million.
Wow. Okay,
The core engine is generating so much capital that it can just digest a multi-million-dollar real estate default without derailing the overall profitability.
So they aren't ignoring the weakness in real estate at all. They are just out-earning it.
They are completely out-earning it, and they have pre-funded the risk.
What do you mean by pre-funded?
Well, the report notes their overall provision for credit losses actually increased to $10.6 million. They maintain an allowance for credit losses of 1.25% of total loans.
Oh, I see.
Yeah, they didn't just stumble into this real estate loss blind. They built a mathematical shock absorber into their balance sheet, specifically designed to handle these exact defaults.
They saw it coming.
They did. They recognized the impaired relationship, took the charge off rather than dragging it out through endless restructuring, and just moved forward.
Which begs the question of how a bank actually offsets a loss like that over the long term. I mean, you can't just rely on interest rates forever. You have to find alternative ways to generate cash.
Right, non-interest income.
Exactly. The sources detail some wild growth in their non-interest income, basically. The hustle and expansion side of the business. Mortgage banking revenue exploded by 208.6% year over year to $1.9 million.
That massive jump in mortgage revenue is primarily driven by secondary market sales and a higher per loan administrative fee.
How does the secondary market sale work in this context?
When they originate a mortgage, rather than keeping that 30-year loan on their own books and tying up all their capital, they package and sell it into the secondary market.
Oh, so they don't hold the risk.
Exactly. They collect an upfront fee for originating the loan, offload the long-term risk to institutional buyers, and immediately free up their capital to make another loan.
It's a high-velocity turnover strategy.
Very high velocity.
And it is not just mortgages either. Service charges on deposit accounts jumped nearly 29% to $3.3 million. The report attributes this specifically to a July 2025 rate hike on their treasury management products.
That's a huge point.
Yeah, because treasury management isn't just a checking account. It is the complex software ecosystem businesses use to manage payroll, optimize cash flow, and prevent fraud. It is deeply embedded into a company's daily operations.
Which demonstrates incredible pricing power on the bank's part.
Because it's too hard to leave.
Exactly. When a bank hikes fees on a service by that much, they usually risk massive customer churn. But treasury management software is so sticky, and the pain of migrating a mid-sized corporation's entire payroll system to a new bank is so high that clients just absorb the rate hike.
It's just easier to pay the fee.
Yes. It proves the immense value of the underlying tech platform ServisFirst has built. They also saw credit card income rise to $2.2 million.
But here is the data point that genuinely confuses me.
Okay, what is it?
They achieved all this non-interest growth, absorbed a $7 million real estate loss, and maintained an efficiency ratio under 30%, all while maintaining what the report calls robust hiring in their new Houston market.
Ah, the Texas expansion.
Yeah. Their book value per share reached $34.99, up 14.5% from a year ago. Expanding into a massive, highly competitive market like Houston requires expensive real estate, signing bonuses, and marketing. How can they expand their geographic footprint that aggressively while remaining that lean? It's like running a marathon while lifting weights.
It definitely seems contradictory until you understand the mechanics of operational leverage.
Operational leverage.
Yeah, think of operational leverage like building a massive toll road, laying the initial asphalt, building the centralized technology, the compliance frameworks, and the back office operations requires a huge upfront cost.
Right.
But once that infrastructure is built, letting 100 new cars drive on it costs you almost nothing in extra maintenance while you collect a toll on every single vehicle.
Oh, I get it. The infrastructure is a fixed cost, but the new revenue is practically pure profit.
This raises an important question, though. Yeah. How many other regional banks actually possess the discipline to operate this way?
Probably not many.
ServisFirst doesn't have to build a new back-office engine every time they enter a new market. They just plug top-tier bankers into their existing, highly scalable system.
Which keeps the overhead insanely low.
Exactly. CEO Tom Broughton makes this point directly in the report, stating, "We believe we have the best commercial bankers in the Southeast."
Confident.
Very. They're relying on high-touch human talent to win business across Alabama, Florida, Georgia, the Carolinas, Tennessee, Texas, and Virginia. The new revenue those bankers generate in Houston flows almost entirely to the bottom line because the back-office costs are already covered by the existing footprint.
And most banks try to buy their way into a new geographic market with a costly, messy merger that takes years to integrate.
Right, which destroy their efficiency ratio.
Meanwhile, ServisFirst is just marching in, hiring the best local talent, and taking market share organically out of pure cash flow.
It's a brilliantly executed playbook.
So what does this all mean for you listening today? We started this deep dive by staring at a digital bouncer, a Cloudflare security block protecting a highly valuable set of raw data from ravenous Wall Street algorithms.
Mm-hmm.
Once we got past that wall, we decoded the actual machinery of a thriving institution. To summarize the takeaway, ServisFirst in Q1 2026 is an absolute masterclass in operational balance.
It really is.
They are playing ironclad defense by hoarding $1.8 billion in cash, pre-funding their real estate risks, and aggressively avoiding expensive, flighty Wall Street gimmicks like brokered deposits.
But simultaneously.
Exactly. Simultaneously, they are playing a relentless offense, hiking administrative fees on sticky corporate software, flipping mortgages into the secondary market, and funding their own expansion deep into Texas.
In a media landscape where we are constantly bombarded by narratives about macroeconomic doom and highly leveraged financial collapses, true institutional health is rarely found in the flashy, headline-grabbing news.
It's buried in the spreadsheets.
It is found by looking at the unglamorous underlying mechanics. It is found in an efficiency ratio of 29.80%.
Right.
It is found in the discipline of dropping your deposit cost by 61 basis points while simultaneously convincing your clients to park an extra $268 million in your vault. That organic relationship building is the actual bedrock of financial stability.
The boring details are entirely where the real money is made. It really makes you rethink the way the broader financial industry operates. Our sources show that ServisFirst generated an incredible return on average common stockholders' equity, increasing from 15.63% a year ago to 17.91% this quarter.
That is a near 18% return on equity.
Just massive numbers. So I want to leave you with a final lingering thought to mull over today.
I love these.
If a quiet regional bank can generate massive 18% returns simply by sticking to traditional relationship banking, aggressively hoarding liquid cash, and refusing to play the Wall Street game of brokered deposits, does that mean the highly complex, massively leveraged banking models we hear so much about are fundamentally flawed?
It's a great question.
Maybe the secret to thriving in the modern financial system isn't building a better algorithmic trading bot to scrape data. Maybe the secret is just getting past the digital bouncers, sitting down at the table and executing the basic math better than anyone else.